Okay, we are here, right? This is the last class period before you take your test, okay? So we're going to do some stuff today, and then after today's lecture and class period, then you need to take your, let's see, that's the fourth test, right? Your fourth test over chapters 8, 9, and the first part of 10, okay? Now, I have a study guide for that test on Angel, and just wherever you always know where to go to get this stuff. It's under the Lessons tab, under the Handouts, and then under the appropriate chapter. This one will be under Chapter 10. So you'll see that handout for the test review sheet, kind of give you some things that I want to make sure that I guarantee you will be on the test, okay? So that'll be out there on Angel for you to get and for you folks at home to get. All right? So the first thing I want to do today is actually go through that homework, okay? I think it was exercise 10.4 through 10.8. Is that correct? So let's go through that real quick. All right? Exercise 10.4. In early January of 2011, LabTech purchases computer equipment for $147,000 to use in operating activities for the next 4 years. It estimates the equipment salvage value at $30,000. Prepare a table showing depreciation and book value for each of the four years, assuming straight line depreciation. Okay? All right, well, let's do that. Well, the first thing that we want to do is figure out how much depreciation we're going to take per year. Is that correct? So what we're going to do is take the, there it is right there. We're going to take the cost of the asset of $147,000 minus the salvage value or the residual value divided by the number of years in its estimated life. And that gives you $29,250 per year. Is that correct? Okay. So then what we want to do is fill out this table. And this just tells us for each year the amount of depreciation that we're going to take. And we're going to say the year-end book value. Once again, what does book value equal? What did we say? We talked about it last time. Book value equals what? Cost minus accumulated depreciation. So the cost in this case is $147,000. 147 minus 29,250 is 117,750. 147,000 minus both of these would be 88,500, and so on. Correct? And of course, you depreciate down to the estimated residual value, and then we're done depreciating. Correct? And in this case, that residual value was $30,000. Okay? That's not too bad, is it? Straight line should be easy points. Okay? Any questions on 10.4? If not, let's go to exercise 10.5 and let's do it. Okay, exercise 10.5. Refer to the information in exercise 10.4. Prepare a table showing depreciation and book value for each of the 4 years, assuming double declining balance depreciation. Okay, well, double declining, which do you all think is harder? Double declining balance or units of production? Double declining, that's usually what most people think. That's usually what most people think. Okay, well, let's go ahead and do that. I don't know if you used the sheet. And did you guys use this little handout I gave you? Okay. You don't need to. I'm going to go ahead, I think, on this one and do it. I'm not going to give you one of these on the test. So this is more to kind of guide you to being able to do it on your own. And it looks like some of you already didn't feel like you needed to use it on your own. Okay? So, all right, can you see this back there? All right? Can you see that? All right. Okay, what is the cost of the asset? Is it $147,000? Is that right? And what's the estimated life? 4 years. And what's the salvage value? $30,000. Okay? So the first thing we take is we take 100% divided by the estimated life, which is 4 years. And that gives us what? 25%. We take that times 2 because this is the double declining balance method, and that gives us 50%. That's our double declining balance rate, correct? So we can go ahead and write that in the squiggly bubble. And we're going to take that times the beginning of the year book value, correct? Now, in the first year, it's just the cost because we haven't taken any depreciation, is it? So it's 50% times $147,000, and that equals what? What'd you get for the first year? 73.5? Okay? 73.5. Okay? The second year, we take the cost of $147,000 minus what we've depreciated so far, which is just what we did in the first year. And we're going to take that times 50%, and we're going to get $36,750. Is that correct? You with me? Okay. Then, the next year, for year 3, we're going to take the cost of $147,000 minus the depreciation from the first year, minus the depreciation from the second year, and take that all times 50%. Okay? Now, if you do that, you get an amount of something like, what is it if you take that calculation? 18,375? Okay. You get 18,375. Is that correct? However, we're now at the stage where there's a problem, isn't there? Because we have now depreciated below the book value. Okay? Thought of another way, you might think of it this way. Oh, yeah. Did I say it wrong? Okay. Thank you for catching me on that. We have now depreciated so that the book value is less than our estimated salvage value. Okay? So let me go ahead and let's take a look at this. Okay? We have our depreciation amounts. I'll try to keep them over here. For year 1, it was $73,500. For year 2, it was $36,750, right? So after year 2, what is our accumulated depreciation?
Yeah.
Is that it? At end of year 2. 110,250 is our accumulated depreciation at the end of year 2, right? Now we can only depreciate, what's the total amount we're going to depreciate? We're going to depreciate, the cost was $147,000, right? And the salvage value or the residual value is $30,000. Is that correct? So we are only going to depreciate a total of $117,000. You see what I'm saying? That's as much as we will depreciate. And we've already depreciated $110,250. Correct? If we depreciate $18,000 more, then we have depreciated below our estimated salvage value, which we can't do. So how much more can we take? If we've taken $110,250 of depreciation and we can only depreciate a total of $117,000, we can only take $67.50 in year 3. We call it forcing that number, right? So let's switch over to this one. So if you look at if you look at our depreciation table, well, we saw that our annual depreciation in year 1 was $73,500, and in year 2 it was $36,750, and then $67,50 is the forced amount. That's all we can take. Because look at the bookend year value now. It's $30,000, right? Isn't that our estimated salvage value? So we're done depreciating, aren't we? Okay. Assets that are only 4 years in estimated life, they depreciate pretty quick under this double declining balance method, don't they? All right, and this one had a pretty high salvage value too. So, okay, so did you get those numbers on double declining? Is there any questions on that? No questions? All right. Well, if there's no questions, let's go on to exercise 10.6. Okay, exercise 10.6. Feng Company installs a computerized manufacturing machine in its factory at the beginning of the year at a cost of $42,300. The machine's useful life is estimated at 10 years or 363,000 units of product with a 6,000 salvage value. During its second year, the machine produces 35,000 units of product. Determine the machine's second year depreciation under the straight line method. Okay? Well, for year 2, or this one's pretty easy, isn't it? And it's going to be the same amount for year 1 and for year 2, right? We're going to take the cost of the asset of $42,300 minus the salvage value of $6,000, and then we take that divided by the estimated useful life of 10 years, and that's going to be $36.30 per year, right? That'll be the amount in the first year and the second year and the third year, right? And so on. So that's the straight line method. Any questions on that? All right. Well, let's move on to 10.7, because I think what they want us to do is determine the machine's second year depreciation using the units of production method. Okay? So let's do that. Well, the first thing that we have to do is we have to figure out our depreciation per unit, don't we? We have to figure out our depreciation per unit. So we take our cost minus our estimated salvage value divided by the total amount of production we think we're going to get out of that thing. 363,000 units. Thus, we're going to depreciate 10 cents per unit each period. How many units did we produce in the second year? 35,000 units. So we take 35,000 times 10 cents per unit, and we get $3,500 depreciation for that first year. Make sense? So that would be our depreciation amount. And of course, the depreciation entry would be a debit to depreciation expense and a credit to accumulated depreciation. Right? Okay, we got one more, right? They want us to do, on exercise 10.8, they want us to refer to that information, figure out the machine's second year depreciation using the double declining balance method. Okay? All right, let's try to get away from my handout now, since we're not going to have that on the test. And let's walk through this. Okay? The first thing that we do is we take 100% divided by 10 years, right? That's going to give us 10%, correct? We take that times 2 since it's the double declining balance method, and thus our double declining balance rate is 20% per year, right? That's our DDB rate. Agreed? Okay. Now we have to go, they're asking for the second year, but we have to do the first year, don't we? So the first year, the depreciation is the cost minus the accumulated depreciation, of which there's none. So it's just $42,300 times 20%, $84,60 is the first year's depreciation. Correct? The second year depreciation, well, first of all, they do this preliminary step, and they say, what's the book value at the beginning of the second year? Well, it's the cost of $42,300 minus what we've depreciated, the accumulated depreciation, is 33,840, right? And then for the second year, we take that beginning of the year book value of 33,840 times the double declining balance rate of 20%, and we get 6768. Cool? You with me? All right, any questions on that? Any questions on that? Okay, what we're going to do now, I am going to, let's work on a handout here, okay? Let me go ahead and put this handout up on the screen, and you can show that while I'm passing it out to you guys. I really want to do one more example in class of these methods. So let's go ahead and, this is the Chapter 1 handout for Phil Murray's vehicle, okay?
Chapter 2.
Sorry, goodness sakes. Thank you, Jake. You're keeping me on my toes today. I appreciate that. What did I say?
Chapter 1.
Yeah, let's go back to Chapter 1. No. This is the Chapter 10 handout for Phil Murray's vehicle. And what I want you to do is, and you will have something like this on the test, is I'm going to give you some information, and I want you to figure out the depreciation for the first 2 years, for 2012 and 2013, under each one of those methods. Okay? So let's go ahead and roll that music and do this. All right? Okay, the answers to this handout, let's go ahead and show them on the screen. These are the answers. I'll show you how we arrived at those answers here in a minute. But if this were a quiz or a test, and these were worth 2 points each or 3 points each, you'd have to either have the number or you'd get it wrong, right? Okay? Kind of like the FIFO LIFO thing. You either have the number or you don't. If you don't have the number on the test, I'm not going to try to figure out where you went wrong. Okay? All right, so those are the answers. Anybody get all 6 of those answers? Raise your hand. Okay? Good, good. Well, let's take a look at how we arrived at those. Okay? Okay, first of all, let's take a look at the straight line method. The straight line method. The straight line method is the cost of $48,000 minus the estimated salvage value of $6,000 divided by 5 years equals $8,400 per year for year 1, for year 2, and so on. Correct? All right, what about the units of production method? Well, the first thing that we do is we take our cost of $48,000 minus our estimated salvage value of $6,000 divided by the total amount of production we think we're going to get out of this asset, which in this case is 150,000 miles. Okay? That gives us 28 cents per mile. Well, in 2012, we're going to take that 28 cents per mile times the number of miles that we drove, which was 37,500, and we'll depreciate $10,500. Okay? In year 2, we take that 28 cents per mile times the number of miles that we drove, which was 48,300, and we'll depreciate 13,524. Correct? What if we drove it 0 miles? We would take 0 depreciation, wouldn't we? Okay? So any questions on straight line or units of production? All right. Let's take a look at double declining balance method. Okay? The first thing that we do is we figure out our straight line rate, which is 100% divided by 5 years equals 20%. Then we take it times 2, and we get a double declining balance rate of 40%. Correct? In year 1, we take the 40% double declining balance rate times the beginning of the year book value. There's no depreciation yet, so it's just the cost. 48,000 times 40% double declining balance rate equals 19,200 for the first year. Correct? Second year, we take the beginning of the year book value, which would be 48,000, minus the depreciation amount that we took in year 1. That's the beginning of the year book value in between my fingers. And we take that times 40%, and that gives us 11,520 for depreciation in year 2. Is that how you did it? Okay. In this case, the production was the number of miles, right? But it could be a number of things. It could be the amount of units that something produced, or, you know, it could be a variety of things. You just have to see how production is measured for that specific asset. All right? So I hope it helped to do one more example in class. I'm certainly going to have something like that on the test. Okay? All right, any questions? Now, I do not have a test review sheet to show you what it looks like and put it on the screen. But again, it is on Angel under the Lessons tab, under the handouts, under Chapter 10. Okay? So that is on there. And we will take the test next class period. For you folks at home, be sure to look at that block of time that I allow you to take that test. Please don't wait until the last day, okay? Somebody always waits till the last day, and then they have car trouble, and then they call me up, and they're panicked and all this. Allow yourself some margin in life, okay? All right, because things happen that are unplanned, okay? All right, so next time we meet, we will be starting the second half of Chapter 10, and you'll have those PowerPoints up on Angel for you to get as well. think we're good to go, aren't we? Okay, so good luck on the test. We'll see you later.